Ever been in a real bind for cash, like your car breaks down and you need it for work, but you're just a few $100 short? Happens to the best of us. Imagine needing $400 for an emergency car repair. Payday loan seems like a quick fix, right? But then, boom. 2 weeks later, you've paid back $460 and you're somehow broke again. Forced to borrow another $400. The average person shells out $520 in fees for an original loan of $375. How is this even possible, let alone legal? Today we're diving deep into the often shady world of payday loan to show you exactly how they're designed to get you hooked and to keep you going. So what exactly is a payday loan? Think of it as a short-term loan, usually $500 or less, that comes with an incredibly high interest rate, and it's usually due by your next payday. You show proof of income, you have a bank account, and you authorize them to take that money back when payday comes along. The appeal is obvious, especially when you're desperate for cash. Car repairs, unexpected bills, or for some people, it's just to keep the lights on. No lengthy approval, often no real credit check. It feels like a lifeline if banks turn you down. But who are these lenders really targeting? Study after study shows they prey on the financially vulnerable and set up in low-income neighborhoods. They often go after renters, people that make under $40,000 a year, and younger adults. A shocking 69% of first-time borrowers use these loans for everyday essentials, not just one-off emergencies. Fast cash promise with easy online applications and bright storefronts. It is incredibly tempting, but it's a carefully crafted illusion, hiding a damaging business model designed to exploit your immediate need. This is where the hell turns into an iron grip. The payday loan hinges on sky-high fees. Think APRs near 400%, sometimes even over 600%. This is compared to the 15 to 30% that credit cards offer. And incredibly short repayment periods, usually just 2 to 4 weeks. If you didn't have an extra few $100 before payday, how likely are you to have it plus the hefty fees after paying all of your regular bills from the same paycheck? The Consumer Financial Protection Bureau found that a staggering 80% of these loans aren't repaid on time, and the lenders count on this. When you can't pay, they usually offer a rollover. You pay the fee, you extend the loan, but that fee does not reduce the actual amount you owe. You're basically just paying for more time to be in debt. This is the debt trap. Research shows that 80% of payday loans are rolled over, and many borrowers renew so often they end up paying more in fees than they do in their original amount borrowed. The CFPB reports 75% of all payday loan fees come from people taking out 10 or more payday loans a year. A $300 loan can easily mean paying hundreds in fees while still owing that $300. It's a financial drain pipe. Now I'm going to get into some heartbreaking stories from the web. Imagine Sandra, who juggled 6 payday loans, paying over $600 a month just in fees, leading to an eviction and her car being repossessed. Or Lisa, a single mom who renewed a $300 loan 35 times, paying $1,250 in fees, while still owing the original $300 because she thought she was getting new money each time. She said, as soon as you get your first loan, you're trapped, unless you know you're going to have $300 in the next 2 weeks. These are not isolated incidents either. They are the predictable outcome of a system designed to exploit people. Beyond the crushing debt, borrowers face overwhelming stress, anxiety, shame, and harassment from debt collectors. It's a devastating cycle, proving that these lenders are not offering a bridge over troubled water, but an anchor to those that are already struggling. Now, the real question is, how do these payday lenders get away with it? Their prime concern is direct access to your bank account. If funds aren't there on payday, they might try a couple times, triggering multiple bank fees for you, digging you even deeper into debt. And their profit model relies on this cycle. 75% of their revenue comes from people taking out over 10 loans a year. It's not a flaw in the system. It's there by design. These lenders also use very clever marketing, highlighting a small fee of like $15 to borrow $100 instead of the shocking 400% APR, creating an illusion of a simple fix. The industry aggressively lobbies against tougher regulations, claiming that they offer a vital service. Some even try to skirt state laws through tactics like tribal lending, though these are being challenged. These operations, whether online or in bright storefronts, are built to squeeze profit from financial desperation. It's easy to blame lenders, but why does our system let these predatory services thrive? A major reason, a lack of affordable small dollar credit line from traditional banks, creating a vacuum for payday lenders to fill with their very harmful products. While some states have strong interest rate caps, usually around 36% APR that effectively curb predatory lending. Many others have really weak rules or loopholes that these lenders expertly exploit. Financial literacy gaps and sheer desperation also play a role. When facing a crisis, people are less likely to scrutinize complex loan terms, and lenders capitalize on this urgency with really deceptive marketing. Ultimately, broader economic issues like stagnant wages and rising cost of living leave many families financially vulnerable. With no emergency savings, this is creating fertile ground for these predatory lenders. Tackling this would require systematic change, not just pointing fingers. If you're caught in a payday loan trap, it can be very overwhelming, but there are ways out. Start by talking to your lender and see if there's a payment plan that can be laid out. Be honest about your situation and know your rights under state laws. Your state commissioner protection office can help. Nonprofit credit counseling agencies, like those affiliated with the NFCC, can offer free or low-cost help. To avoid this trap altogether though, explore safer alternatives. Credit unions offer payday alternative loans with capped APRs around 28% and also have longer repayment terms. Some banks are also starting to offer affordable small dollar loans. And remember, building a small emergency fund is key for long term. Now here's my call to action. The most powerful weapon against these predatory practices is awareness and action. Please share this video to educate others about the dangers of payday loans and safer alternatives. You could save somebody from a devastating debt trap. If you've had a payday loan debt experience, please leave it down in the comments below. And one of the biggest things, always do your research before borrowing. Understand the terms, the APR, the total cost. Don't let urgency cloud your judgment. The world of payday loan is indeed a tough one. Marketed as a quick fix, but systematically designed to trap financially vulnerable people. Those sky-high fees and impossibly short repayment plans, and the aggressive tactics are not accidents. They're the core of a multi-billion-dollar industry built on exploiting desperation. While some regulations offer a sliver of protection, the fundamental predatory nature often persists. But understanding how this trap works is the first step in dismantling it. By shining light on these operations, sharing stories, promoting real, affordable alternatives, and advocating for strong enforced regulations, we can empower people to avoid these financial nightmares. The fight for financial fairness is ongoing, but with knowledge and collective action, we can work towards a future where nobody has to go to a predator in their moment of need. Alrighty guys, thank you so much for watching. If you did make it all the way to this video and you enjoyed it, make sure to like and subscribe, and I'll see you in the next one.